We'll just give it a second for people to join before we kick off. Okay, I think that's a good number we've already got. So, very warm welcome. Good morning, everyone, and welcome to our Summer Economic Forum. This is a webinar where we will talk through the UK and global forecast that we put out earlier this week. So in a second, I'll hand over to my colleague Ben Caswell, who'll talk you through the kind of highlights of the forecast. And then the format of this is, I think, Ben, your presentation is around 25 minutes. We'll then open the floor to Q&A. So it's basically lots of time to have a discussion about the judgments we're making and the outlook as we see it. If you have questions, you can basically just type them in the chat function as we go through, and then I will kind of go through the list and pose those questions to Ben and colleagues afterwards. But with that, let me hand over to Ben to talk us through the highlights.
Thanks, David. So, morning, everybody. Welcome to our economic outlook, which we've titled Challenging Inheritance. So this is a contribution with every name that you see on the screen here. So it's a really big thanks to everybody that put the effort in to make this product possible. So just to kick off with our key messages. So first is that the Middle East remains a large source of uncertainty in our forecast, but our central case assumes a relatively swift normalization. So we don't expect the conflict to drag on or escalate in our central path. In the global economy, there are two important forces at work. So one of these is higher energy prices stemming from the conflict and the uncertainty which that brings. And the second is AI investment boom. So these two sort of forces are keeping the global economy kind of steady in some sense. Turning to the UK has proved more resilience than we expected relative to our April forecast. We think GDP is going to grow 1.1% this year and next. However, the shock is not without any cost whatsoever. This will squeeze real government spending and leave the Chancellor with some tough calls in the autumn budget. So turning to the global outlook, this is our conditioning path for oil prices. As you can see here, we've plotted the oil price path in red with our two previous forecasts in the dashed lines. So you can see that our winter forecast is much lower, while our spring forecast is the highest. So we've revised the path down a little bit here. So we expect oil prices to average around $74 a barrel in Q3, and then gently declining to $62 a barrel at the end of next year and staying around there. So essentially, we have a slightly improved outlook for oil prices relative to last time. Of course, escalation in the Middle East remains a key risk to this conditioning assumption. So turning to our growth outlook for the global economy, global growth is pretty much unchanged from where we were last quarter, and it's chugging along at around 3%. And again, growth forecast for the emerging and advanced economies is little changed. Now, part of the reason for this is these offsetting forces, which I mentioned. So there are some winners and losers from these two forces. In particular, you might want to think of it as the extra sort of excess in terms of uncertainty and higher energy prices. Whether you are a sort of beneficiary from that or whether you can weather that storm depends on the extent to which you're a net exporter or net importer of energy. So in the case of the US, they happen to be a net exporter, so they are slightly more insulated from this shock relative to Japan, which imports essentially all of its energy, so it's much more exposed. On the AI side, the US is very much at the sort of frontier of AI developments and is very much riding that tailwind of the AI investment boom, whereas Japan, on the other hand, doesn't have as much investment in AI. So you can see here that there's sort of a story where these advanced economies are exposed to the shock to different extents from these opposing forces. Meanwhile, the emerging market economies are still growing quite quickly at nearly double the speed of the advanced economies, as you can see here. Obviously, closure to the Strait of Hormuz still remains a risk, even if global peace is achieved, and that's because all of the uncertainty that's built up over this time. So even if there was a quick resolution, we wouldn't expect everything to sort of unwind and get better very, very quickly. Turning to our inflation forecast for the global economy, inflation gathers pace globally, and you can see our sort of average inflation path here in the red, and the dashed line represents our previous path. The sort of main story here is that the peak for inflation is a little bit lower, but the path is more persistent. And this essentially reflects our slightly lower oil price path relative to our last forecast and the increase in uncertainty from the conflict being dragged out. So the takeaway really is that the peak is slightly lower, but inflation is a little bit more dragged out. In the OECD economies, we have inflation of around 3%, excluding Turkey, falling to 2.7% next year. And we also expect the Fed to cut rates late next year, while the ECB is going to hold going forward after a rise recently. I think the main risk to this here is that there is significant disruption to fertilizers. So around 30% of global fertilizer exports transits the Strait of Hormuz. Fertilizers are an important input into food prices. So if this flow of fertilizers is disrupted for a long period of time, it impacts on the growing seasons and the agricultural harvest, particularly in the southern hemisphere, which will start its growing season soon. So this cost of higher input prices through higher fertilizers, or just not using fertilizers, is likely going to affect crop yields and push up food prices. And this could drive global food inflation later this year and early into next year, with some potential pass-through to headline consumer prices in the global economy. So that pretty much covers our global outlook. Turning to our UK economic outlook now. So our growth forecast for the UK is 1.1 for this year and next year. And you can see that's a slight upward revision from where we were in the spring. You can see our spring forecast is actually in these grey kind of dashed ghostly bars. The upward revision reflects a few things. So one is that Q1 was just very strong, stronger than we expected. So you had about 0.6% growth in Q1. And that kind of just arithmetically just takes the average up because Q1 was very strong. In addition to that, Q2 was also strengthened by this kind of stockpiling effect. Manufacturing sector actually did better than expected. Some of the PMIs held up as well. And we think this kind of stockpiling effect was driven by uncertainty. So that also helped kind of weather the sort of second quarter in terms of the GDP growth outlook. That may unwind later on, but it's definitely helped us kind of boost growth so far this year. And then in addition to that, obviously, as I mentioned, the oil price path is revised down slightly from where we were in the spring. So if you take these three factors together, you kind of get a sort of small upward revision in our forecast relative to the spring. The spring was pretty much the height of the uncertainty and height of the conflict so far. Now, obviously, because there is a lot of uncertainty here in terms of the oil price path, you might want to have something like a ready reckoner or some kind of elasticity that's going to help you navigate the idea that oil prices and energy prices might change again in the future. So we've run some simulations in NIGEM, and our estimates indicate that around a 10% increase in oil and gas prices for the UK economy would result in around a 0.04 percentage point decrease in the annual growth rate. So that's just kind of a ready reckoner elasticity that you can kind of scale up and down depending on movements in oil and gas prices. So turning to our first our contributions to GDP growth. So just to unpack a little bit more about where growth is coming from in the economy this year, it's worth emphasizing that government purchases are still supporting GDP growth. Government spending is still a tailwind to growth. Before next year, it will turn slightly more negative because there are backloaded tax rises. So fiscal policy will start to sort of slowly become less of a contribution to growth going forward from next year and on. So the correct way to read this chart really is to look at the first column and look at the size of those bars, and then take that as kind of like your sort of steady state normal sort of growth, and then see whether the bars are bigger or smaller relative to the 2008-19 average. So you can see that the pink bar is bigger than the 2008-19 average. So it's saying that basically fiscal policy is a tailwind to growth. But in 27 and 28, it's a bit smaller. So it's turning into a tailwind to growth. So here you can see that government sort of spending through that kind of loosening at the budget in 2024 is still providing some uplift and support to growth. But what you can also see here is that the contribution from investment, which is the gray bar, is very small. So investment growth has been very weak margins have been squeezed from firms due to higher input prices. So producer prices have gone up quite significantly. In addition, you have this legacy of the national minimum wage hikes and the NIC hikes as well. And all of this has just contributed to a big squeeze for firms, and investment intentions through survey data has sort of indicated that capital expenditure for UK firms, the intention is really, really very low. It also reflects a lot of uncertainty internationally and domestically as well. And the last point I'd like to focus on is, again, net trade. So it's the idea that there's this kind of terms of trade shock and that the UK economy is particularly exposed. We know that the UK imports around half of its energy. Therefore, you can't really change your energy consumption very quickly or very easily. The demand is quite inelastic. Therefore, if the price goes up, the oil price goes up, you pretty much end up importing the same amount because you need to use the energy. As a result, your import volumes just sort of arithmetically, automatically go up, and therefore your net trade position worsens. So that's a real terms of trade shock. And you can see here that in 2026, the blue bar is providing a drag on GDP growth for the UK economy. And that's representing that terms of trade shock, which I mentioned. So turning to inflation, we've got our outlook from the spring and from the summer. Again, this mirrors the global economy. The peak is slightly lower, but the path is more persistent because of this uncertainty, this greater persistence. Inflation actually reaches below 2.5% from the first quarter of 2028 onwards. Now, if you want to interpret that as being within the Bank of England's sort of 1 percentage point range, so 0.5 above and 0.5 below the 2% target, you're pretty much within the target range from 2028 onwards, and then arriving fully at 2% in 2029. So this extra persistence is, again, driven by the uncertainty and the pass-through on the supply side, which I mentioned earlier. Again, to sort of retro apply this estimate that we've done for the scenarios and the simulations we've run in NIGEM, you can interpret this as an elasticity on the inflation side. So a 10% rise in oil and gas prices for the UK economy adds around 0.2 percentage points to headline inflation annually. So that's a kind of ready reckoner that, again, can kind of help you adjust the UK forecast or central case if energy prices change again. So turning to monetary policy, what does this mean for the Bank of England? Well, we had the monetary policy report yesterday, and we had the bank's decision, which was to hold rates. Now, we expect the Monetary Policy Committee to hold rates until at least 2028. What we've got here is our conditioning assumption. So this is the path that we believe that the bank will take. This is not the market path. But I've added the market path from the most recent outturn here, which was just from a couple of days ago. And you can see that the market is actually quite aggressively pricing in interest rate hikes. They've actually got 3 by the middle of next year. So that's quite an increase. It's quite a difference. However, we think because there is limited risk of second round effects because of sufficient weakness in the labour market and demand conditions, we think that even though the initial shock may be significant, that the second round effect risk is quite low just because of that wage setting part in the labour market is not going to allow to pass back through to producer prices. So we think that the Bank of England, what they're going to do is probably just hold and look through at the moment. We think that's the most likely choice, and that reflects our conditioning assumption for rates being held where they are for the next year and a bit. So turning to the labour market, we can take a look at our unemployment forecast here. We now expect unemployment to rise to 5.3% by the end of this year, which is slightly below our April forecast, which was a bit more pessimistic. We had it going up to 5.5%. And this reflects a few things. So the data outturns on unemployment were a bit of a surprise on the downside. They're definitely more positive than a lot of people were anticipating. However, this lower unemployment rate also reflects a kind of weaker labour supply. So there was this trend of decreasing inactivity, people coming back into the labour market. That's kind of stopped. Inactivity edged a little bit up in the last data release. So we think that this is also driven sort of mechanically by a sort of inactivity sort of trend there as well. In addition, vacancies, although they are still declining, they're not declining as quickly as they were in the past few years. But if you look at the Q2, Q1 this year vacancy posting, it was down almost 1%. Again, that's small, but it's indicative that labour demand is continuing to sort of weaken a little bit there. So we think that this is going to essentially have a small uplift to unemployment. In general, employment growth has held steady over the last sort of couple of quarters, but we do expect that to soften. As a result, we've got unemployment sort of just ticking up very lightly, and then it's returning to 5% later in the forecast. Wages are also normalizing as well, and we don't see that there to be a significant second round effect from wages either. So turning to sort of fiscal policy and the government's sort of budget and the challenges they may face in the autumn, we think that there's going to be a squeeze on real government spending. So what we mean by this is think of it just purely in real terms, right? So there's a supply shock, there's less oil available. This real supply shock affects the economy. The economy doesn't grow as much. This affects both the public and the private sector, right? So private sector is around 55% of GDP spending. Government is around 45% of GDP spending, kind of an even split. So this reduction in growth is affecting public and private sector. There's simply less stuff to go around. And another way to think about it is perhaps if you put it in the context of a sort of analogy of like a household or yourself, right? You can't really change how much energy you use. When the price of energy goes up, you're pretty much going to use the same amount of electricity or put the same amount of petrol in your car because you have to drive places and go places. So you can't really adjust the quantity that you use that much. So when the price goes up, it means that you have to forego and give up less of other things. So maybe that means you take less meals out, or you kind of put off buying that new pair of shoes that you've always wanted or something like that, right? So you kind of have to forego those extra things. And really the same thing essentially applies to the government as well, right? Prices have gone up for energy. There's literally less stuff to go around. In the case of the government purchasing stuff, they're not going to be purchasing restaurant meals and new shoes maybe, but they might instead be buying teachers or filling in potholes, right? So they're going to do less of that real stuff. They can't buy as much as they could before with the same pot of money. So what we're saying is that this real squeeze is reflecting the real terms of trade shock that we were talking about. Now, if you were to restore these real earnings path, essentially that would require a reallocation of resources, a reallocation of real resources from the private sector to the public sector to restore where you were at the March EFO. We don't think that that's really viable because essentially it would mean more tax rises or more borrowing, and we don't really think there's the space to do that. So the sort of natural path is that you would basically absorb some of these costs. The UK is fundamentally poorer from a terms of trade shock. That holds true for the public sector as well as the private sector. Now, turning to the debt ratio. Now, the debt ratio is obviously sort of measured more in nominal space, and because we have higher inflation, the debt outlook looks a little bit better. So the government debt ratio is fairly stable, but remains high. It's around sort of 94, 93%. This stability and this sort of better forecast relative to the OBR's March is reflecting a higher inflation path, higher nominal activity, raises the denominator, and it makes the public finances look a bit better, makes it easier to meet the fiscal rules. But what it's saying is that the government is basically set to broadly meet its fiscal rules and have debt stable. Meanwhile, there's this real squeeze effect, right? So you kind of have these two things. The government is set to buy less and do less in real terms, even as it meets its sort of fiscal targets. In addition to that, we do think that debt is generally quite high, and debt interest payments are around 3.6% of GDP. It's important to get debt down because you want to minimize debt interest payments. Those are things that could be actually spent on other parts of the economy. So it could be education, health, but it ends up being over 110 billion. So it's quite a significant amount. And this sort of takes us again to the sort of effect of this debt ratchet, which we have sort of focused on a little bit in our outlook. So here I've just plotted, again, it's the debt to GDP ratio for the public sector. And you can see that the recession bars are shaded in gray. And basically, this is over the last 25 years or so. You can see that each shock, each recession, you have this big ratchet up. So there's a shock and a recession, the government spends more, they intervene, they try to sort of smooth out the business cycle shocks. And you can see that debt essentially goes up as a ratio of GDP. And then after the shock has kind of subsided, it just stabilizes at a new high level. This is true for the sort of the financial crisis, and this is also true for the pandemic as well. So you can see you are sort of stable at just above 30%, and then you get a ratchet because of a big shock. You're stable at 80%. You get a big ratchet because of the pandemic. You end up at 94%. And it seems like with every shock, you just end up at a permanently higher debt level, which you never bring down. So what we're saying here is that in order to build space for the next shock or recession, whenever that arrives, is that you need a fiscal consolidation via higher primary surpluses in order to actually start bringing the debt ratio down, not just stabilizing it, but bringing it further down So what we need is a kind of consolidation on the fiscal side, not a further fiscal loosening. That's essentially what we're saying here. So there's been a few topical issues that we've sort of dealt with in this outlook, and it kind of reflects our challenging inheritance title as well. There are three boxes which I recommend you to sort of read all of them. One is on defense spending and productivity. I don't have time to go into that one today, but I recommend reading it. It's very good. And then we also have the outlook for NEETs. So again, in the context of the Milburn review, we are kind of talking about the NEETs issue. And then the third box is on Manchesterism. And again, that's essentially in reference to the new Prime Minister. So we're going to have a look at the performance of Manchester as a region and how it's fared relative to other places. So on the NEETs issue, I think it's kind of worth bringing out the split of NEETs. That's even interesting and useful in itself. So the current split of NEETs in the UK is around 40% are unemployed and around 60% are inactive. So quite a lot of them are inactive. And the rise in NEET inactivity, particularly since 2020, I mean, we're thinking about the pandemic here, it's been concentrated in sort of sickness and disability as well. So that is also a sort of a real concern. And the people who are NEET that are citing mental health as a primary condition has risen quite substantially in the last 15 years. So it's around a 25% increase in the last 15 years. So that's quite significant. And it suggests that there's serious policy sort of recommendations that need to ameliorate some of those trends. In terms of the regional breakdown of NEETs as well, this is kind of interesting and ties in with the second box, is that there's quite a variation across the ITL1 regions of the UK. Even as just a summary, it's kind of stark. So what you might see here is that the biggest increase in NEETs between 2019 and 2025 is actually in the East Midlands and the Northeast. And in the Northeast, it's almost entirely driven by increase in inactive NEETs as well. So it's quite a range here. And what you might notice as well is that Northwest is actually has a small reduction in NEETs, and that's also driven by lower unemployment of young people. So we know what's in the Northwest. Greater Manchester is in the Northwest. So I don't know if they claim credit for the sort of policies of Andy Burnham as the mayor, but it is interesting that there has been a decline in unemployed NEETs in the Northwest of England. And you can see that even in a sort of more granular level, if you compare Greater Manchester with Merseyside, there's quite a difference between NEETs. So NEETs rates have actually gone up slightly in Merseyside, which is very nearby city, and Greater Manchester, it's actually fallen slightly. But in the context of the Milburn review and the interim report essentially recommended a system reset on NEETs. So it's still a live topical issue, and we expect that the amount of NEETs is probably going to stay around 1 million over the next few years. So it's something that definitely requires attention. So turning to the sort of third box, Manchesterism, it sort of ties in with the regional story of NEETs as well, is that Manchester has enjoyed higher productivity growth during Andy Burnham's mayoralty. Higher productivity has also raised gross disposable household income as well. So that's also higher than the UK average. But these sort of higher household incomes have not only been concentrated in central Manchester, but the regions around it, so the whole of Greater Manchester. And one way of thinking about that is in terms of regional spillovers. So here I plot the annual median wage of residents and workers. And the idea here is that like Manchester as a centre is a net exporter of wages. So there's some sort of spillover to the regions here. And here you've got Manchester, like the centre, which is on the figure, but it's on the right side. And it's comparing the median salary, the median gross salary of residents versus workers. So here in Manchester, you can see that the worker salary exceeds the resident salary. And that's because there's a lot of people that sort of live around Manchester that commute in and work there because it's quite a dynamic and growing economy. What you can also see here in 2023 is that the resident salary for the surrounding areas like Bolton, Bury, Rochdale, Stockport, etc., they're actually higher than the people that work in those areas. So again, that's indicative of Manchester kind of being a growing centre, which brings people in and then sort of exports next wages. So you've got these spillovers, which are having quite positive effects for the whole of the Northwest region. And again, that's reflected in the better sort of outturn for NEETs as well. So median wages and median growth in these regions have actually exceeded the UK average for 2017 to 2023. So maybe there are some lessons for growth here as well. So this summarizes our two sort of boxes that we decided to focus on. Just wrapping up and returning to our key messages. Again, Middle East conflict remains our key source of uncertainty for our forecast. The global economy is still being impacted by these two forces, which I mentioned, which is higher energy prices and the AI investment boom tailwind. UK economy is more resilient than we thought a quarter ago, and we expect growth to sort of chug along at 1.1. And I think also importantly that there are quite challenging trade-offs in the autumn budget for the new chancellor, not just because of the extra pressures on defense spending, green transition, social care, all of these big important problems. But on top of that, you have to layer the real shock, which is coming from the oil prices and coming from the terms of trade shock. That means that the public sector, as well as the private sector, is going to be smaller in real terms. It's going to have less growth than it otherwise would have. So you've got all of these structural long-term issues on defense spending, on NEETs, on everything else, but you've also got that real shock layered on top, which is the day-to-day spending of government is not going to go as far as it did or as we thought it would do in January. So that means very tough trade-offs as well for the Chancellor. And given that the fiscal rules are pretty tight in terms of there's not much headroom there, it means that there's going to be very tough decisions going forward. So I will conclude there, and I'm happy to hand back to David, and we can sort of take questions and have a discussion. Thank you.
Wonderful. Thank you, Ben. That was very good, very clear. So we have plenty of time for your questions. And if you have a question to the panel, please put it in the chat, and I can see there's a number in there already. I think I'm going to start with one kind of clarifying question just myself, which is we obviously had the Bank of England's forecast released yesterday with the NPR. Ben, it might be helpful just if you kind of contextualize, our forecast versus theirs, where the big differences are, where the points of agreement are.
Yeah, absolutely. So our GDP forecast for the next couple of years is very, very close to the banks. But we have a different view on trend growth as well. So the bank has a view of sort of 1.75. We're close to 1.25. So in the sort of medium term, 26 and 27, means that they've got actually a larger negative output gap than us. So you can kind of think of the bank's view is that there's more slack in the economy than we think. That's one. And then the second one, which is related to that, is their inflation forecast. Their inflation forecast is peaking at the same quarter as ours, which is 2027 Q1, but the peak is around half a percentage point lower. So in Q1, our average is 3.7. That's where we peak. The bank peaks at 3.2. And also, in addition to that, the bank has inflation falling quite rapidly after there, where we have greater persistence. Now, the reason for that difference in the persistence of the path and the peak is two reasons. First one is that the bank conditions their forecast on the forward OIS yield curve. So basically, because the market is quite aggressively pricing in rate rises, their conditioning assumption is that they've got 3 rate rises. Whether that happens or not is another question. But what it means is that later in the bank's forecast, inflation comes down very rapidly in response to those 3 aggressive hikes. And as a result, in 28, actually, inflation goes below target. It goes to 1.7 for almost a year. So that's reflecting that the fact that monetary policy would have an aggressive tightening in the bank's forecast because of that conditioning assumption of the market curve. However, in ours, we actually impose what we think the bank is going to do, and we think the bank is going to look through and hold. So as a sort of like-for-like comparison, we have a less restrictive path of monetary policy in our forecast compared to the bank. Therefore, we have greater persistence in inflation. So those things are working together to lead us to a higher peak and greater persistence. In addition, our trend growth forecast is also different. We have 1.25, the bank has 1.75. So because they've got a larger negative output gap and more slack, they think that actually the economic underlying sort of weakness is sufficient that inflation will peak as well in the next sort of 3 quarters at a lower point. So these things together explain the difference in our forecast for inflation between us and the bank.
Okay, thanks. So a big thing is the conditioning path and the fact we're effectively assuming there isn't going to be a hike in our central forecast. And they've got, was it 2 or 3? It's a kind of
3.
a more aggressive 3.
Yeah.
Very good. Thank you. So there's a load of great questions already in the chat, and I'm going to kind of try and group them together. And, please put your questions in there as we go through. Stephen, I might ask if you want to take this first one. So there's a question from Robert Timper, who is really asking about the risk of higher realized inflation due to the energy shock leading into higher wage demand. So I guess a question about what's our assessment of these famous second round effects so far? What's your perspective on that?
Thank you. Yes, no, our assumption is that if things develop the way we expect them to, i.e., there's a relatively quick cessation of hostilities, the Strait of Hormuz starts operating something close to normality by maybe the end of the year, then inflation will come down. We do not expect there to be any second round effects because workers will see that. But more importantly, the labor market is actually slackening at the minute. And in a slackening labor market, it's much higher for work, it's much harder rather for workers to push for higher wages. And this is, of course, very different to the situation when we had the last oil price shock that was associated with the Russian invasion of Ukraine, where the labor market was incredibly tight at that point. And so the rise in inflation was immediately put into higher wage demands. So I think that's the key difference. This time the labor market is slackening, whereas last time it was really, really tight. And as a result of the fact it's slackening this time, this is why we don't think there'll be any second round effects. But that is on the assumption that the strait returns to normality, oil prices return to normality relatively quickly. If inflation were to stay higher for longer, and the Middle East situation were not to resolve, then we might be in a position where we see second round effects.
Great, very clear. Thank you. Maybe another one then. So this is a question from David Ronicle. Ben, I think I'll ask you to take this one. So it relates to this squeeze that we have in our forecast that we're emphasizing. So he says, I was struck by your PSND forecast. Would be great to unpack it. Yes, inflation raises the denominator, but it also raises tax revenues and also the cost of government spending. So your real government spending squeeze. So he's kind of asking what's stopping nominal spending going up? Obviously we're conditioning to the government's pre-announced plans, but what prevents there being the answer to the squeeze just being higher cash spending?
Yeah, yeah, absolutely. Yeah, no, it's a great question. Obviously, we condition our spending paths on the OBRs announced for government consumption and government investment. So we take those paths as nominal, and then we sort of let our sort of like deflators and the rest of our forecast do the work. But what I would say is that you can just think about it in terms of purely the real effects, right? So there is a supply shock, there's a real terms of trade shock, as I mentioned with the sort of energy price example. You can't really change the amount of energy used very easily. So if the price of it goes up, you purchase higher volumes of it, it means you have to forego something else. There's less of something else. And as a result, the private sector is not going to grow quite as much in real terms as it was in January. And that also holds true for the public sector as well. So government purchases, government consumption goes not as far in purchasing real things. So that's where the squeeze comes from on that side. I mean, I accept that, there is a little bit of a sort of nominal friction as well. There's a bit of a nominal tailwind to debt, which comes from higher inflation as well. That also is reflected in the fact that we have a more persistent path. But if you sort of take a look at the OBR's path, it's conditioned on inflation being at 2%, I mean, literally from now onwards. So we have quite different nominal paths, and that would also explain the differences there. In fact, we do actually have transfers being endogenous. So we do have some spending which is not fixed as well. So again, we have a slightly lower unemployment path, improvement in transfers as well. That's also kind of helped government spending not go up quite so much.
Great, thank you. I hope that answers your question, David. So I want to turn to, there's a couple of great questions from James Smith in the chat. James, I might do these in reverse order so we could kind of stick with fiscal policy for a second. And Stephen, I don't know if you want to take this. So the question is, interested in the panel's views on how the government should react to the deterioration in the outlook for the public finances coming from the conflict in the Middle East. Should it respond by tightening or trying to cushion the economic impact? That's a good
Yeah,
question.
that is a great question. I mean, the problem that we have is that every time the government cushions the impact of a shock, the debt to GDP ratio rises. I mean, that was the wonderful ratchet chart, if you like, that Ben showed towards the end of his presentation. Um, and I think we're in the position now where we've got to say, we can't afford to allow debt to keep ratcheting up. There's a point in which, we have to bring it down precisely so that we have some room to deal with the next shock, to be able to cushion the blow. Um, so, it's very unpopular to say, but I think my answer to the question is really that the government needs to recognize the fact that it has less money and so tighten. I think that's the answer, I'm afraid.
Very clear. Thank you. I'm sure that's a debate that will go on and on. There's a couple of other fiscal questions. I just want to take these all in one group. So, firstly, a question from John Geeve. Ben, why don't you take this one? How much extra headroom is there within the fiscal rules to mitigate the real squeeze on public spending?
So I think our answer to that question is that we don't forecast headroom. The only official forecaster of headroom is the OBR. But what we do forecast is the variables that make up headroom. So our forecast for the current budget deficit is that it's essentially in balance. It hasn't changed massively since our last couple of forecasts. And again, that represents the fact of higher nominal activity being a little bit of a tailwind to tax receipts as well. But the real squeeze is there, and the real squeeze is coming from that in terms of trade shock. So the economy is growing less strongly. In terms of the fiscal rules, our view on that hasn't really changed over the last two forecasts. There's minimal change in our numbers there. We still think the buffer is very small, and we're actually trying to de-emphasize this sort of concept of headroom. We don't think it's particularly useful to have just this single point estimate. It's much better to kind of look at the overall path and the overall trajectory for public finances. So look at the projected path for primary surpluses, look at the projected path for the debt to GDP ratio. Those are still the fundamental things which are important. And when we look at the primary surplus path, it's not really high enough to bring the debt ratio down. It's just high enough to stabilize it. And the ultimate arbiter of whether public finances are sustainable is whether public sector net debt grows unbounded as a share of GDP. And at the moment, maybe it's not growing unbounded, but it's pretty high and it's not falling. So I think the fiscal rules are important as a communication, but ultimately, sort of fiscal sustainability is much broader than that.
Okay, thank you. We'll do one more on fiscal, and then we'll change gear and bring some of the other panelists in. So back to you, Stephen. This is a question from Michael Clark. Debt to GDP is a huge problem for the country. What are the options for the government without a return to austerity? And is it realistic to get debt below the pre-COVID levels anytime soon?
Well, that's a fantastic question, and the quick answer to the very last bit of it is probably not. But that shouldn't stop you from sort of getting the direction of travel right, if you like. What can you do without doing austerity? I guess you always have a choice, right? You can say, I can reduce the primary deficits by reducing spending, or I could do it equally well by increasing taxation. And I mean, the amount of spending, government spending as a proportion of GDP is fundamentally it's a political view. Is how much of economic activity do you want directed by the government? And that's a matter for the government. So I'm not going to comment on that. But what I would say is that if you're in a position where you want to be spending more, you want to maintain the level of public services where they are now, then you have got to raise taxes to pay for it, to pay for that. That's the only way you can bring the debt down. When thinking about raising taxes, though, I think a good place to start would be asking yourself, where are the inefficiencies in the tax system? Where are the distortions in the tax system? Where is the tax system sort of subsidizing various activities at the expense of other activities, or where is it the government are not actually raising much tax despite the fact that there are quite a few pages of tax code. If you can find those areas and sort out those distortions and make the tax code simpler, then you can very easily find yourself in a position where you're raising more tax revenue without actually raising tax rates. So I think what the government needs to do really is to look at the tax system, look for inefficiencies in the tax system, and try and get rid of those.
Wonderful. Okay, very clear. Let's there's some questions on monetary policy, but I'm going to come back to those at the end. And I want to switch gear, if that's okay, to let's take some questions on NEETs. So I'm going to bring in Emma Simpson, who was the author of the box on that. So Emma, if you don't mind tackling these. So the first question is really a factual one. Can you remind me of the percentage of NEETs citing mental health as their primary condition? And I think there's a question about it being around 24% in 2011. Where are we now?
I think that the figure that Ben gave was around 42%. So that's quite an increase.
Lovely. And then the kind of broader question, this is from Leslie. Oh, I'm not going to be able to pronounce your name. Gunday. Forgive me if I have that wrong, Leslie. Given the policy focus on needs, shouldn't we expecting some meaningful reduction? So we had a forecast that basically said, this is largely acyclical, and we're anticipating the number of needs to stay roughly constant. Shouldn't we be expecting a fall? Emma, what do you think the kind of determinants are, I suppose, of where we're heading?
Um, I think it's going to take time. I mean, I think that as Ben explained and as the box goes into more detail about the increase in NEETs is about the increase in young people who are economically inactive. And I think that and a lot of those are citing mental health reasons. And as the Milburn report says, there needs to be a whole system reset. It's not an easy answer. And if you think about the barriers that mental health presents to engaging in employment, they're not things that can be turned around quickly. So yes, I think that over time, we would hope to see a reduction in needs for sure. But it takes time to tackle those mental health issues. It takes time to ensure that employers are equipped with the kind of policies in their businesses which enable them to support young people who might be experiencing challenges to stay in work. It's not just about getting the job, it's also about staying in jobs. There's also been, we know that Burnham's committed to looking at sort of vocational and technical pathways, which I think will be a very welcome and have a positive impact for sure. However, again, these take time. The system at the moment is very convoluted and very difficult for people to navigate. And so that's going to take time to untangle. So yes, I think that hopefully things will improve, but that because it's such a complex problem, with such an intersection of healthcare systems, of social care systems, of education, of the labour market, it's going to take time for those policy changes to have real impact.
Thank you. And can you remind us the timing? So when does the final Milburn report come out?
So that's coming out in October. There'll be a report with all the recommendations that he's making, and so then that will prompt some policy change. One hopes.
Thank you very much. All right, let's take some questions on some of the other. One's just popped in on NEETs as well, which is this is from Dimitri Korpakis, who asks, "It's a time to envisage a kind of universal, unconditional income for young people to overcome some of these issues," and he's linking this to the potential impact of AI on the job market. So I don't know if you have a quick comment on that one, Emma.
Yeah, absolutely. I mean, I think that the income is one thing, and that it sort of brings in the whole kind of welfare issue as well. I think that the support's got to sit behind it. It's not just about providing the income. It's about the whole nature of engagement and why young people aren't engaging in the labour market, and what can be done to increase that and to spark their interest, to make them want to. So yes, indeed, that may help, but you've got to tackle the support issues very much alongside that.
Thank you. And sorry, I have just seen this. There's a question from Nikki Morgan as well, who asks, how does the unemployment figure Ben referred to interact with the figures for NEETs, particularly the economically inactive figure? Ben, I don't know if you want to comment on how the economically inactive NEETs are kind of feeding into the unemployment figures. Just clarify that.
Yeah, I mean the split in terms of inactive and unemployed is, as Emma mentioned, it's sort of close to 60-40 split. That's quite different from the rest of the population. Youth unemployment is also significantly higher than the average as well, so they make up a sort of quite significant share of the unemployed. In the box, we have a figure, I think it's the first figure in the box, which has like a breakdown. So it's kind of a square and it like chops up the needs by sort of inactive, unemployed, and then it looks at like how that sort of is sort of spread among those different categories. So I haven't got that in the slide, but it is in the box. So I recommend taking a look at, I think it's the first figure in the box. It has a nice breakdown of that.
Great, thank you. Thanks for your question, Nikki, as well. All right, let's take some questions on one of the other boxes that looked at the Manchester model. So, Adrian, I'll bring you in on this one if that's okay. So, the question from Dimitri Korpakis: how constrained is the Manchester model by national fiscal rules, high borrowing costs, and limited new devolved funding, particularly in light of the challenging inheritance that we outline in our reports? Do you want to speak to that question?
Yeah, it's another great question. Thank you. And I think the main point to make here is that Manchester's recent productivity performance didn't really rely on a lot of support from the centre in terms of, fiscal devolution or lots more spending. A lot of it was driven essentially by being able to attract foreign direct investment and also investment in things like property. And so I guess the question is for cities like Manchester, other second tier cities in the UK that we know are lagging behind their counterparts in other advanced economies, how can they attract more investment, more private sector investment? And maybe public investment can play a role here. But the key thing is really to create the conditions for business investment, because we know that ultimately, whether it's second tier cities or the UK aggregate economy, we need much more private sector investment if we want to get growth going, if we want to raise productivity and reduce inequality. So I think the Manchester model can work without some of the big forms of redistribution that perhaps might have happened, a while back. That I think is the key point really about Manchester.
Thank you. Um, there's another question, Adrian, I'd like you to take if you will. It's by Richard Tufts, forgive me. Let's see if I got the question right. So in the EU, regions develop smart specialization strategies to set priorities for cohesion spending. That's the first part. By abolishing RDAs, what is that? Regional development authorities. Forgive me.
Agencies. Yeah.
Agencies. You can talk to what they are a little bit, but by abolishing these things, did the UK make a major or a minor error? What's your perspective on that? And explain what RDAs were,
Yeah, I think
please.
Yeah. So regional development agencies were set up under New Labour, and then they were abolished by the coalition government and replaced by these sort of local enterprise partnerships. I think the main point really is this. There's been a lot of churn, and that's not helped regional policy. Successive governments have changed, institutions have changed, funding streams, there's been a lot of instability, which was really created domestically, which has not helped in a very uncertain context, both since the financial crisis and more recently with Brexit and COVID and all the shocks. So I think institutional stability does matter. It's better to stick with a set of institutions and make them work rather than change them around all the time. I think that's point number one. Point number two is we did benefit, or regions across the UK did benefit from EU funding, and we've never really fully replaced it. The levelling up funding that came in sort of after 2022 never fully replaced the regional funding that parts of the UK lost. I think that's point number two. And point number three is, you got to find ways of not just doing it from the center, but devolving, because there's a better sense of interest and needs. So there is a case to think about, how can we rebalance power? Because at the moment, Whitehall and Westminster do a lot. They control much more expenditure, much more tax revenue than in comparable advanced economies. So can we think of sensible forms of devolution that more gets done at local and regional levels? And the center in turn can focus on its own priorities. the things we've already discussed, like defense and welfare, and really make sure it can act rather than micromanage everything across the board.
All right, excellent. There's another question on the Manchester model that's just come in by Jeremy Holmes. So, Adrian, maybe you can take this. So, the question is, as you mentioned, FDI, foreign direct investment, was important to the Manchester model. Do you know how it was generated? Were there local agencies involved? Which countries it came from and which sectors? So, what do we know about that, please?
Yeah, so I think there's a number of things. I mean, one is a lot of it did come from the US. So there's an interesting link there with US, private equity and venture capital, and I think it's something definitely to explore because we know that the only other area that's been able to attract that amount of foreign direct investment from the US has been London and parts of the Southeast. So Manchester has clearly done quite well attracting that. I mean, some of it's just to do with things like direct flights from Manchester to the US. I mean, it's quite interesting. These things really matter. So infrastructure and things like, close transport links are important here. Other things are, yes, trying to create incentives for people to invest there rather than in London and the Southeast. And some of that could be to do with rates of return because there is a certain catch up. And you could see how, for instance, property investment could really work because the value of property is already very high in London and the Southeast, whereas in Manchester it's much lower. So again, this sort of creates incentives for direct investment. That doesn't mean that you can translate that model to all other second tier cities. There will, of course, be big differences. But I think some of those lessons from the Manchester model are well worth thinking about for other second tier cities.
Lovely, thank you. Leah, I would like to bring you in next, if I may. A question on the global forecast. So maybe this is just a clarification question about oil prices. There was a lot of talk a quarter ago about oil prices rising a lot more than they actually have done. We're clearly still in a quite volatile situation, but at least one of the narratives that I've read about, as to kind of why the rise in prices hasn't been greater, given the degree of supply shock we've seen, has to do with the Chinese authorities' actions, demand destruction in China. Could you kind of give us a little bit of context there as to kind of what we've learned, I suppose, about how oil supply shocks are impacting the global energy markets?
Yes, of course. Thank you very much. What I can say about this is China, as other countries have been digging into their oil inventories or oil reserves, and have reduced their purchases of oil from the Gulf countries to reduce the exposure to higher oil prices. And without being their primary intention, the collateral of this is that it has reduced the pressure on global demand on oil, and this has contributed to a probably lesser oil prices than we would otherwise have had if the demand would have stayed the same. So in the continuity of this, I can say that if China and the other countries were to restart their purchases at the same level as before the conflict from the Gulf countries, this would reinforce the demand for oil for the same constrained supply, if we assume that the conflict is not resolved or that the supply disruptions are not solved yet. So this would mechanically increase prices again, potentially to a higher price level than we've seen so far. And this would, as all the countries, impact the UK inflation as well.
Thank you very much. Very clear. All right. I want to shift gear, trying to group the questions, and forgive me, we don't get through them all, but we'll do our very best. So let's shift back to monetary policy, if that's possible. Stephen, I think if it's okay, I'll bring you in on this one. This is another very good question by James Smith, who asks really about this kind of scenario approach the Bank of England has been trying to develop. So he says he didn't see an adverse market reaction to the BOE's announcement yesterday in the same way as we did see that adverse reaction to the Fed's hold. So is this a sign that the bank's scenario analysis is doing a better job of anchoring policy expectations than Governor Warsh's more evasive approach? I guess this is the context here is these two central banks are moving in quite different directions with communication strategy. So how do you see this playing out?
Yeah, I mean, it's an excellent question, and I think the very quick answer is yes. I think it's more than just the scenario analysis. I think it's communication overall. I think it was people have been given a fairly clear steer over the month and a half since the last monetary policy decision that unless things change dramatically, the MPC was going to hold, and the markets expected them to hold, and they did hold. The Fed, on the other hand, yes, I think people are genuinely worried that they're moving towards a less transparent operational model, and that does create jitters in the markets. If the markets find it harder to work out what the Fed are doing, then they're going to wind up responding much more on the days of individual decisions. That will certainly happen. Coming back to the Bank of England, though, what's going to be crucial, I think, over the next 2 or 3 monetary policy decisions is how the bank communicates and how the market responds. It's fairly clear, I think, from the monetary policy report that came out yesterday that the bank is expecting a lower interest rate path than the markets are currently. And so the question for the bank is whether their communication can bring the market path down to something closer to what they're kind of envisaging in their thinking at the minute. And if they don't, well, you might see an adverse reaction next time if the bank hold or the time after that, where the markets are beginning to expect rises.
I think you're highlighting exactly the right issue there, and I wonder whether they're a little bit happy with where the curve is because it's this Maradona story that it's doing some of the work for the bank in terms of kind of weighing down on second round effects, but whether they actually want to see that through and validate the curve is another thing. So I fully agree with you that the challenge for the bank is still to come on this. Let's do another one if we can on QT. If I can find it. Martin Wheatcroft asked, Stephen, if you don't mind, I'll bring you back in on this one. In response to the deterioration, should the Bank of England pause its QT program of gilt sales, which are pushing up yields and hence the cost of government borrowing? I think if I got this correct, there was an update yesterday in the NPR on what the impact the bank thinks QT is actually having on gilt yields, and I think what's eventually happened is they keep revising up the impact that they think QT is having, albeit from a very small starting point to kind of a not a huge impact, but I forget the number, it's in the order of 20-25 basis points. But that still makes quite a big difference to the fiscal position. What would your advice be to the bank on QT?
Well, the difficulty about pausing QT specifically an effect on government borrowing is that you're getting into the position where the Bank of England is starting to do things first. They're not acting independently. If, on the other hand, they were thinking that, long rates are too high at the minute, with the result that inflation is going to go below target, then they might think, well, okay, in our armory, we could pause QT. That'll have a bit of an effect on long rates, which means you might be in a better position to hit your inflation target. But that's the thinking that they need to do to remain independent. The thinking has got to be, what is the effect of this policy on inflation? Are we in the right place from that point of view? Not, are we doing the right thing for government borrowing?
All right, very clear. Thank you. There's a great follow-up question to our earlier discussion from somebody at Pantheon Macro, I think it's not really a question, really. I think you're pointing out that there is this discrepancy between where we think that the MPC will what it'll want to do with interest rates and where the curve currently is. And I guess the question is, how long do we think this kind of gap can continue? I might ask the second question, though, from Pantheon in the 1 minute we have left. How do you think about the MPC's forecast scenarios all being consistent with a rate hike on an optimal policy rule against your view that rates need to be held? This is ultimately, is a more sensible path for rates holding them where they are or where the market curve is. Ben, do you want to have a last word on that point?
Yeah, sure. No, it's a great question. So what I would emphasize is that all of the bank scenarios condition on that market curve. There's no flat rate, for example. What they tweak in the scenarios is the oil price, essentially. Everything else is pretty much constant. So really the variation you're getting in the scenarios is all driven through oil price changes, energy price changes, not the Bank of England sort of reaction function, if you want to think of it like that. So the question for how long the gap can persist, again, that's going to be conditional on the bank's communication strategy as well. I think the sort of from the pure sort of market lens as well, the question is how quickly will inflationary pressures subside? What's the global uncertainty? I mean, Leia's point, for example, on the demand destruction in China, winding down imports, that has also been an uplift. So I think that's got to be considered. In addition, I think even if hostilities do sort of wrap up, there's this sort of a lag effect as well. So, for example, ships are in the wrong place. People don't trust the peace deals and the announcements. When there was this agreement, we saw that ships didn't start transiting back through the strait immediately. Everyone was not convinced that it was sufficiently safe to do so. On top of that, there's still infrastructure that's been damaged and that hasn't been fixed. So you've kind of got layers and layers upon which you'd have to sort of repair to get back to anything like full capacity. So I can understandably see why the market's sort of cautious and pricing in those rises. I think what we're saying, though, with our forecast is not that we think that that is necessarily the sort of optimal strategy, but we think the bank is going to look through. And that's because there's sufficient weakness in the labor market that producer prices being passed on to consumer prices and then through to wages is not going to just sort of reach that full circle. So we don't think that that kind of bargaining effect is then going to go back into input prices for firms. And that's why we think that the bank is really just going to have to look through this shock rather than move. But obviously there's going to be a case for both sides. We don't sort of dispute that. But as things stand, as they are currently, we think that looking through and holding is going to be the sort of the most likely decision that the bank is going to take.
All right, very good. We're out of time, I'm afraid. So I hope I've done some justice to your questions. Forgive me if I didn't literally read your question out, but we had quite a large number. Big appreciation to all of you for joining and the great discussion we've just had, and to all the panelists for fielding some really difficult but good questions. So see you all soon, but thanks for joining. Have a good Friday.